All right, so we are going to look at a question from risk management, and I'm sure this is not the first question of a sort, but today we are looking at a short one from section B, and basically what if differentiates section A from section B is maybe the sheer volume of content that is not given to you in section B, whereby whatever they give you is something that you can easily digest and be able to actually be able to attempt. And also section B tends to have mostly, like most risk questions will be there. Although as we've seen in section A, risk question also can come in section A, whereby you are going to look at calculating the amount that is going to be received or payable in maybe 3 months time, hedging and all those other things. So this question here called Gogarth, if you look at what is asked of us, they are asking us to advise Gogarth on and recommend an appropriate hedging strategy for the cash inflow on 31st August. And then, of course, discuss the role of Gogarth's treasury function in relation to the management of economic risk, in relation to foreign exchange, and then 5 marks for analysis and evaluation and commercial acumen in your answer. So you can see that for section B, you are given 20 marks, but as you're getting those 20 marks, you get 5 marks as well. That is if you have done the right analysis and commercial acumen. So what that means really is that you can be able to easily get 20 marks in a question. And if you get 20 marks in a question, another 20 marks in another question, so you already have reached 40. And regardless of how, unless you complete the fumble section A, then you are still able to pass. And then, of course, my advice is to always make sure that the majority of the marks you are getting are coming from section A, so that you are using section B to cover up so that you reach 50 and surpass it. So, if you look at what is given to us, they're saying that we have been given Gogarth's currency risk management, and then also some board queries. So when it comes to the risk management, they are saying that we are an electrical equipment manufacturer based in Malaysia. They want to develop operation abroad. One of the biggest sales market is the USA, and we also import components from the USA. So we hedge transactions in foreign currencies. Right now it is 1st May, and on 31st August, we are expecting to pay $14.5 million for American suppliers, but also receive $37.4 million from another customer on the same day. So here is what we have been given regarding exchange rates. So the spot, and they're giving us as US dollar per Malaysian ringgit. So that always means that the Malaysian ringgit is the base currency. So some people confuse this and say the country where you are is the base currency, which is usually true, but the examiner can confuse you by giving you Malaysian ringgit per US dollar, and the US dollar becomes the base currency. So the idea should always be the one which is quoted as 1 is the base currency. So US dollar per Malaysian ringgit means that $0.2355 per Malaysian ringgit. So the Malaysian ringgit becomes the base currency. And it will be very important for you to know that, because if you get that wrong, then most of the things that come next, you might get them wrong. So you have the spot, and they give you 2 rates here because one is for when the bank is buying, and then the other one is when the bank is selling. So then they give you also a forward rate. So that means this is for the forward rate. Then they also give us for the futures, when you have a contract size of 500,000 Malaysian ringgit, future price is quoted as dollars per Malaysian ringgit. So they are giving you June and September futures. So you have to choose which of the futures will be appropriate to use, and we shall see how that works. And then we have also the options. So futures, forward, and then the option. So the option, same contract size, exercise price is quoted at dollars per Malaysian ringgit. The premium is quoted in cents per Malaysian ringgit. So we have September, June calls and puts. So then they're giving you different one exercise price for the different instruments, and then you have the premiums that are quoted to you. So we have to determine, first of all, whether we shall use calls or puts. Then we shall use September or June. So the futures are option contract are mature at month end. The number of contracts to be used should be rounded to the nearest whole number in calculations. The amount cannot be hedged using an exact number of futures, options, or contracts. The amount unhedged or overhedged should be hedged using the forward market rate. Now, last time, I think when we did the question, I said that sometimes when you're hedging, you may not get a perfect hedge. But then I also said that in the exam, if the examiner does not really fuss you about it, you could round off and maybe not talk about that over or under hedge based on the time that you may be having available. But in case you have time, then you should look out for how much has been unhedged or how much has been overhedged. And here they have told us that if you find such amount, you should use that. You should use the forward market rate for that hedge. And even if they don't tell you, that's what mostly happens. You hedge that remaining amount by the forward market. So also we are going to assume that options are exercised. So it means that we are not going to deal with having to decide whether or not to exercise the option or not. So all those things save you calculation time that you may have wasted trying to determine whether the option is valid to be exercised or not. So that's the first part of the question, and you can easily answer that before going to the board queries. But the board, especially the head of the treasury function, gave a presentation about treasury function and what it does and to manage the foreign exchange risk at the last board meeting. So a new non-executive director has stated that he understands what the treasury function does in relation to the management of transaction risk, but does not understand treasury function's role in management of economic risk. So you have seen they are telling you transaction risk, economic risk. For you to be able to answer this question very well, you need to know what these two are, such that you can be able to say, like they're asking us here, how does treasury function come into play regarding the different risks? And here they have told us to look at only economic risk because that's what they wanted to understand. They were not clear on what they exactly do with that kind of risk. So let's first start with the first part of this question. And of course, so when you look at this, as I told you, we have been given forward, futures, and options. So we have to determine what is going to be the output of the transaction under these three methods. Now, so first of all, what we need to know is that it's first May. So May, June, July, August. Those are 4 months. And that's why they have given us a 4 months forward rate. So, but they could have given you another forward rate of like 7 months, then they want you to choose. So don't just be there thinking, okay, whatever they give me, that means that's the period. Just determine how much time is going to pass between now and when that transaction is happening. So 4 months time. So in 4 months time, so first of all, we are expecting to pay 14.5 million and receive 37.4 million. So what you can do is to get what we call a net amount. Because what you have to understand is that if I'm going to receive money and pay money on the same day, then it makes sense that I actually offset those different payments and receipts so that I don't have to first convert everything that I pay to dollars, then I pay. Then I also get all the dollars that I've received and convert them to Malaysian ringgit. It makes sense to offset that 14.5 million so that when I receive the 37.4, I pick 14.5 and pay it, and the remainder is what I'm going to now to actually go and convert. So this is the net receipt. So net receipt, the net receipt is 22.9 million in 4 months' time. So when I use the forward rate is always easy. They have given us the 4 months forward rate. We just need to know what is going to happen. Which rate are we using? Are we using this 0.2370 or 0.2374? Now, so how do you determine that? As I told you that we are using the base currency as the Malaysian ringgit. Now, we are going to receive dollars. That means that we are going to have to sell those dollars. In other words, we are going to buy Malaysian ringgit. So when you are buying the base currency, the bank is selling to you the base currency. Remember, we said that the first one is the bank buys, second one the bank sells. So the bank is going to sell to you at 0.2374. That's one. The other thing is that we are going to actually decide whether we are going to multiply or divide. Okay. So what I need to make clear so that you understand, I'm going to kind of sort of like try to do a summary for you so that you can understand exactly what I'm referring to here. So first of all, we said we first know the base currency is the Malaysian ringgit. So now, after understanding the Malaysian ringgit is the base currency, then we know the transaction itself. The transaction is that on that day, we shall sell dollars or we shall buy the Malaysian ringgit. MR. Okay, that's what is going to happen on that day. We shall sell or we shall buy. Just give me a second. Sorry. So as I was saying, that the transaction is that we shall have to sell dollars, we shall have to buy Malaysian ringgit. And then I said, when you are looking at the rate, the way the rate is quoted, they put a buy and a sell rate. Okay, for example, the spot they gave us 0.2355, and then they gave us 0.2358. Then they gave for the forward 0.2370 and 0.2374. So those are the rates that they gave us. Now, I said that when you see buy and sell, you need to understand who is buying, who is selling. Because remember, for us, we are going to have to sell dollars or we are going to buy Malaysian ringgit. Okay? And since we are going to buy Malaysian ringgit, the bank is going to sell it to us. So this buy and sell here is for the bank. The bank buys at this, the bank sells at this. So that means that for the forward rate, it is easy. We are going to use this rate. And then also, since we are converting to Malaysian ringgit, we are converting to the base currency. So when converting the base currency, we divide. Okay, and then when converting to the counter currency, we multiply. So these are some of the things that you need to know. So therefore, for the forward rate, all I need to do is to get the 22.9 and divide it by 0.2374. That is the expected money in Malaysian ringgit. Okay? So that is the forward rate. Very easy like that. But you just need to, first of all, you have to determine which transaction is happening, what's the base currency, and then you determine how to deal with it. But as soon as you understand it, then you are okay. Now for the futures. Now, first of all, for the futures, they have given us June and September. Now, if the transaction is going to happen on 31st August, that is after June, okay? Because usually the futures are given to us in 3 months, so they give us March, June, September, and December. So now it means that you have to basically determine which futures you are using. So we are using in this case September futures because the transaction will have passed June, so we can't use June. So we have to use September futures. So September futures. Now, when you buy a futures price, it's basically still going to be, again, trying to determine a price that you will use at a given date. The difference between a future and a forward rate is that the future is not over the counter. They don't give you a rate. but rather go out in the market and you buy what is available. So if these are September futures, remember we are buying them at 0.2378. So if you do that, so the expected receipt will be this divided by 0.2378. But that is what would have happened had you bought the September futures and you're going to actually have the transaction happen on the last day of September. But remember, ours is happening on that 1st August. So there's going to be some kind of basis that you need to account for. But why do we do this? Is that we can be able to determine how many contracts we need. So contracts that are needed, remember that they are saying that each of the contract is 500,000 Malaysian ringgit. So we divide this by 500,000. So that gives us 192.6. Now, they told us that the transaction that we are going to do, we are going to have to deal with contracts in whole number, because that's what happens in the market. In the market, you can't go and say, give me 2.5 contracts. You get 2 or 3 contracts. So if we are going to buy 192.6 contracts, we can therefore buy, for example, 193 contracts. So when you do so, we have bought more than what we need. So we shall actually have overshot. So we shall have over-hedged. So therefore, we are going to have to deal with overhedge. If you chose 192, then you have done an underhedge, then you have to deal with it. So you have to determine what ends up being either over or underhedge. Now, from there, as I said, since we are going to buy this transaction, yes, Joshua.
I was just checking, where is that 96,299,411 coming from?
The value of the September future is 0.2378. The currency future prices. So means that if we are to use that as a conversion factor for this $22.9 million that we are receiving, that is equivalent to 96 point about 299 million Malaysian ringgits.
So we are converting the receipt into the currency of the contract size.
Yes, so that we can know how many contracts we need.
Okay.
Yeah. So now from there, as I said, since we have to get our transaction in August and rather this ending in September, so we are going to have to calculate basis. Now for basis, what you need to do is basically calculate. Basis is usually the difference between the futures price, which is 0.2378, and the spot. Okay? And the spot. And remember, since we already know that we are supposed to be using the value for selling, we are supposed to subtract this 0.2358 and this 0.2378. So that's what should give us the futures price. And normally, we take it as spot minus the future price itself. So which means that we are going to have 0.2358 minus 0.2378. So that gives us 0.002 as the basis. But what we need is what we call the unexpired basis. Basically, This basis covers the period from now to September, but we are in August. So how many months are left before we finish September? Because this is end of August, so it's just 1 month left. And from now, where it's 1st of May to September, it's May, June, July, August, September. It's 5 months. So we are left with 1 month out of the 5 months on this basis. So which leaves us with a value which is unexpired basis of 0.004. So to get what we call the lock-in rate, or the predicted value that we are going to be incurring at that date of August, given that we are not finishing the entire future, is basically you go and get the September future, and then you add, you add the unexpired basis. So you get 0.2378, and then you add this basis here, which is unexpired. So which gives us 0.2374. So, and you can see that it is different from the September future. So the difference, as we said, is the unexpired basis, and therefore it means that instead of using 0.2378, we should actually use 0.2374 for this date of August 31st. So if we get that, now we can try to determine. So if that's the case, so what am I going to use for what? For the transaction, how much will I actually receive? Because we are not receiving 96.299. We are going to basically receive the rate when you multiply by this or divide by this, but also consider the amount which you actually overhedged. So first of all, what is the amount that we overhedged? So the overhedge, we bought 193 contracts, okay? And if you get 193 contracts and multiply by the 500,000, and then we compare with this. We compare with this 4 months forward, okay? But on the selling side, 2374. So that gives you how much you would get as overhead. So if you compare that with the figure that the net receipt, that should tell you how much you have under or overhead. So now remember this is, if you multiply that by 0.2374, which is our lock-in rate, okay? So that gives you how much? That gives you 22.909. And you can see that we are actually only receiving 22.9. So in other words, we have overhedged by this 9,000 here. Okay. Now this 9,000 that we have overhedged, we have to convert it, because now it means that we have extra dollars. So we need to convert that. So in order to get the overhead, we need to subtract this amount so that you can get the exact figure, $9,100. So, and they told us that for that, since now we have overhead by that, we shall receive less money, and we shall have to get some other dollars, $9,000, to actually clear that. So we shall need to go and look at the 4 months forward rate. So, and we are going to buy, okay, we are going to buy Malaysian ringgit with that extra dollar. So now, so what is the payment when we are buying the Malaysian ringgit? We just divide this by. Now we are going to we are going to buy. We have overhedged. So it means that the person is expecting us to give him more dollars, but we don't have more dollars. So we are going to have to buy dollars. Near that, we are going to have to sell Malaysian ringgit. And the bank buys the Malaysian ringgit from us at 0.2370. So 0.2370. So this is the extra amount of Malaysian ringgit that we are going to have to pay. So now we know that. So let's see how much now. If we put it together, so the amount which is received, from futures, it's going to be 193 contracts by 500,000. Okay, that one we have already agreed. But because we have overhedged, we are going to have to make a payment for overhedge, which we have already calculated at 38,000 Malaysian ringgit, which means that we actually are going to get 96.461. This is the net receipt when we are using futures. So I've put here a summary up so that we compare these values. Remember, these are Malaysian ringgits. Okay, now the next thing we have to look at is the option now. So the option, as we saw, gives you the right but not the obligation. Okay, so the right but not the obligation, which means that with the option, given that it gives you the right but not the obligation, you are able to exercise if things are favorable. But then if they are not, you should be able to not exercise. And therefore, because of that, it comes with a premium. But now we need to understand, are we going to have calls or puts? Okay? Are we going to have calls or puts? Now, usually, when you are going to make that decision for foreign exchange currency, you have to look at the contract size. The contract size is quoted in Malaysian ringgit. And we are going to have to purchase Malaysian ringgit. Okay? Because remember, they are going to give us dollars, so we have to purchase Malaysian ringgit. So if we have to purchase the currency under which the contract size is quoted, then we buy call options. Okay, I repeat. If we are going to have to purchase the currency which is quoted for the contract size, we purchase call options. On the other hand, if we are going to have to sell that currency, that means buy dollars, if that was the case, then we would use put options. So it depends. Remember, call option is the option to buy, and we are buying the currency of the contract. So that's how it should be, easy for you to remember. So in this case, we are going to have to purchase call options, and we already know that the date is not going to manage to work out for June. So we shall have to actually buy September call options. So we are going to have to buy September call options. So after that, we know that we are going to buy September call options. Now, on a normal day, you do now need to check whether you exercise or not, those things. But here they told us that we should assume that that the options are going to be exercised. So it means if we buy September call options, so that means that we are buying them at 2368. So how much will I receive? I receive the same amount, 22.9, but I divide it by 2368, 0.2368. So I'll receive 96.7. And therefore, the contracts will be, remember, each one is 500,000. So I have 193.4, and I can still say 193 contracts. Now, in this case, since I've said 193 contracts, I have under-hedged. Okay, remember before, it was 192, then 193, we over-hedged. But now here, I have under-hedged. So when I under-hedge, it means that I have told these people that I'm receiving 22.9 million, but what I have actually hedged for is less than that. That means that I'll have some extra dollars that I will need to actually sell at the forward rate. So the outcome will be, so the difference is just, okay, if I'm to sort it out without going through these loops that we went up here, because now we understand, we shall get the amount from the option. Okay? Remember, it is 193 contracts, each one at 500,000. That is 96.5. Then I will have the premium. Now the premium has been given to us as 0.14. Remember, these are cents for each Malaysian ringgit. So what we normally do with this, we know that we have 193 contracts, and these are cents. So we can actually get how much premium. So it's going to be 193 contracts multiplied by 0.14 cents, also 0.14 over 100, right? Or you can say 0.0014, and then times the contract size. So that gives you the premium. But that premium, since this amount here from 0014 is in cents, or rather dollars right now, this amount here is going to be in dollars. Okay? So I need to convert it to Malaysian ringgit. And I'll do that at the spot rate. Because when you are going through this contract, you actually pay the premium right away. So I pay the premium right now on 1st May. So I'll have to use the spot rate. Now the spot rate, so the spot rate we have 0.2355 and 0.2358. Now remember, what we have there is premium, and we are paying it in cents. So we need to actually sell. Okay, we need to convert to dollars. So we need to actually sell Malaysian ringgit, and the bank buys them at 0.2355. So we use 0.2355. So that gives us the premium in dollars. And I'm just going to make it a minus because it is a cash outflow. Now, the other thing is the underhedge. So if you find that this is too much to put in one cell, you can split it out. As if you check the solution, you find that perhaps it has been split up. But I mean, if you can put it in one cell, saves you time, but it risks you making a mistake. So I mean, you have to figure out which one is better by practicing. Now, to determine what is the under hedge, we said, okay, we said that we are looking at 193 contracts, and each one is 500,000. And then we multiply by the amount which we said 0.2368. So basically, when we do this, we are actually hedging 22.851 as opposed to 22.9, right? So the under hedge is the difference between 22.9 and this. So we actually under hedged by 48,800, but these are dollars. So we have to convert them. But since I said that we under hedged, it means that we actually are going to have these dollars and we need to convert them. So we have dollars and we want to sell them, or we want to buy Malaysian ringgit. And if we want to buy Malaysian ringgit, the bank sells them at 0.2374. So we divide that by let's put brackets here so that you can divide. So that is the amount which is under hedged. So now, because this is going to be given to us, remember we had extra dollars, so we shall get more Malaysian ringgit. This is premium which is paid. This is how much we have received. So when you add everything up, you end up with 96.131. And that's what we shall receive for the options. Now, the other thing now you should need to do is to check between amongst these three, which one gives us the highest figure. So 96,461,668. The forward rate gives us the higher amount. So the question was asking us, because you need to, at the end of the day, answer the question, advise and recommend an appropriate hedging strategy for it using cash flow, including relevant calculations. So you would have calculated and probably given these as a table which summarizes it, that the receipt in Malaysian ringgit and the forward rate is 96.461, then for futures, and then for options, and then you advise. So how do you advise? So how you advise basically is going to be based on the fact that given that the forward rate gives us a higher receipt than the futures and the options, then that should be the one that we take. However, the forward rate suffers what we call default risk. Default risk means we have agreed this rate, everything is fine, but 4 months from now, when we receive our dollars, we could go to the bank and the bank tells us we don't have the money to give you. So then they don't actually exchange, which will force you to now go out to the market and use the spot rate, which means that you will not have survived the risk. So that's the problem with these forward contracts. They are not really contracts. They are forward agreements, really. Forward rate agreements. There's always a risk of default risk. So now, if that's the case, then which one is better? The thing about the futures is that also they suffer what we call basis risk. Here we have assumed, as we calculated, that the basis diminishes to 0. So that's why we are able to get this unexpired basis by comparing how much time is left on the basis that we have. But that's not always the case. So futures are not so good on that ground. They first have a basis risk, but also they have what we call margin call requirements, whereby they expect you to to pay them some deposit, and then you always are called on to cover up the margin in case you have a day where you have better or worse in terms of the result that are coming out. So they suffer from that as well. So, but that is not so big a problem, because usually the money that they ask you for the margin call is usually small. So you can really not say that okay, futures are bad because of that. But they have basis risk, and also which means that at the end of the day you may reach that date, and the price that you are actually getting is less than what you quoted before, and you make a loss. And then other options are the ones that are scoring the list here. They are still better options compared to the two, because the options give you the right, as I said, but not an obligation, which means that when things are working out well, uh, you could actually discard the option and go to the market in case the market is favorable for you. But things are not working out well, then you have a minimum that you are going to pay. So basically, it kind of gives you a minimum that you will receive, but it doesn't cap you on the maximum. That's the option. There is another instrument called the collar, which actually caps you in both cases, but that's not what was asked of us here. So that is the first part. And I hope that part is clear, because now I want us to go to the second part. Any question before we move to the second part? No. Okay. So, and I know this kind of confused sometimes, so you need to, when you are doing these questions or when you're practicing, go through all of them and the solutions, so that you are able to consistently see how they are choosing whether to buy, sell, call, or put options. So that should give you an understanding of how to deal with them. And please be aware that this is some question that you might not miss in your exam, either in section A or section B. If you miss this one, you get the one of interest rate. So basically, one of these shows up. And then they are telling us to discuss the treasury function and look at it in terms of managing economic risk when it comes to foreign exchange. Now, we need to first go back to what the examiner was telling us regarding that risk. He said that the non-executive says they understand how it does when it comes to transaction risk, but doesn't understand it in terms of economic risk. Now, the risks that we expect to see fall under transaction risk, translation risk, and economic risk. And transaction risk means that a receipt, that an amount, a foreign amount payable or receivable differs, okay? Differs on the date of payment. And what I'm trying to mean here is, if I expect to receive $300 in 3 months' time, if I'm to convert that to shillings right now, and I know that it is maybe, let's say, I don't know if we have conversion of, no, we don't have. Let me just say I'm using a rate of 300 times 3,800 right now. And I'm saying, okay, that is 1.14 million. But this is in 4 months' time. Now, 4 months' time come, and actually, the rate has changed to 3,600. And therefore, I receive less. That is transaction risk. Okay, it only happens when there is a payable or a receivable. Transaction risk here is just a risk that a foreign amount on a and this foreign amount can also be a payable or receivable, but it can also be assets. But usually assets are written put down in book value, which is usually the currency that they are reporting in. So this may not happen for it. But if a foreign payable or receivable is translated at the end of year, at year end, and the value differs. I'm just paraphrasing this so that you understand the value differs from the previous year. Basically, it is the same thing as transaction risk, except that we are not settling this balance. It's just that we are writing that in our books we have receivables of 1.14, and now they are now receivables 1.08. And when this happens, usually we recognize what we call a loss on foreign currency, but it is not yet realized. It is called an unrealized loss because those movements keep on happening, and then transactions, at the end of the day, whichever you settle at, that's the right amount. So this one is not really a problem for risk management. This is the problem, and also this one. This one normally we call it the long-term transaction risk, because it is the risk that a project becomes a positive NPV project becomes negative due to adverse movement in FX rates. But this one tends to be a little bit longer term than the transaction risk. So having understood those risks, remember when you're answering this question, they are not asking you to really explain what those things are, but you can put them in one paragraph really, just to set the stage. Okay? Just to set the stage. So now, so where do treasury people come in? Okay? So the treasury people, where do they come in? They can monitor cash flows more prone to FX changes. So that is one. For example, maybe there is a problem occurring and one of your suppliers is in the Middle East, and the Middle East is having political instability, and therefore the FX rates, there's inflation happening there. So those are cash flows that they monitor. And if those transactions that may end up, the cash flows, not transactions, the cash flows that may end up suffering are identified, then you can choose to actually have those hedged, leaving the others unhedged. So now, they also monitor, because remember these things are long term, they also monitor other factors like inflation, okay, like inflation that may impact the exchange rate. Now, remember, things that affect the FX rate can be got from the interest rate parity and purchasing power parity, whereby things like tax and those other things, taxation, okay, interest rates, they can monitor those. Then they determine which ones to hedge, okay. So the other thing is that they can also look at things like diversification. Now here, we are not diversifying businesses, but we are diversifying perhaps suppliers. If one of those suppliers is in a place which is going to suffer, you have other suppliers somewhere else. Customers, that is, in case you have a problem, like in this case, we are having issues. Maybe the dollar may be rising against the ringgit. So, and you are selling to the Americans. So you can also think of selling to other people other than the Americans. So basically, those are some of the things that they can consider. And this is how they play in. At the bottom line, what we have to say is that treasury function not only looks at short-term FX changes, which is the transaction risk mostly, but also long-term ones, okay? As we showed above. You can start this as the statement and then you put these things. What I'm going to advise you, first of all, I don't know if there are questions for me. Are there any questions? No? Okay, so what
None from me for now.
yeah?
None from me for now.
Okay. So what I'm going to advise you is to go and look at this solution, especially for that section, so that's part B where they are discussing the treasury roles and everything and see how they are phrasing it. And then also maybe look at the calculation, see if they have done differently from ours. Sometimes Kaplan shows you how you would have put it on the Excel spreadsheet so that you can have better understanding of how it is done. So I advise that you go look at that. So today we are going to stop here. Then we shall look at another question tomorrow, another question or two. We shall see how that day goes. But I'm going to share this one so that you can go through it and then find where issues arise and everything. If you have any questions, you can also still send them to me. Have a good night and see you tomorrow.
Thank you, Herbert.
You're welcome.